Alright, so now let's talk about moving averages. And moving averages are the most important tool I use to determine the trend of the price as well as to determine support and resistance to enter the trade. So this is the most important tool that you got to pay attention to. Alright. So first of all, what are moving averages? Moving averages are a mathematical calculation to calculate the moving average over a certain price duration. Right? So for example, a very common moving average is the 50 moving average, the 50 period moving average. So for example, if you're looking at 15-minute candles, right, 15-minute candles, and you apply the 50 moving average, what does it mean? Okay, so in this case, you can see that these are 15-minute candles, right? These are 15-minute candles, and the blue line is the 50 moving average. So what does it mean again? It means that you take the last 50 periods of the price, or the last, remember, one period is 15 minutes, right? So you take the last 50 periods, you add it together and divide by 50, you get a 50 period average. And you keep repeating this calculation after every 50 minutes, right? Take the last 50, divide by 50, last 50, divide by 50, and you plot the answer on the chart, and you will get this blue line. Well, it's blue because I set it to be blue, right? You can set whatever color you want, but I like to use blue for the 50 moving average. Now, obviously, you do not have to do the calculation yourself. It is all plotted using the charting software. And we're going to use MT4 to plot the moving averages. All you got to know is how to use the moving averages. Okay? So moving averages are very important. Why? Because these moving averages, or these lines, like this blue line, they indicate to us the trend direction, and they indicate to us support and resistance level. All right? So you can see, I'm going to teach you this in a short while, but just to preempt you, when the moving average is sloping up, it's an uptrend. So this is an uptrend, right? Clear enough? And when the moving average is sloping down, it's a downtrend. Sloping up, uptrend, right? That's pretty simple, right? So again, if you take a look at the moving average, sloping up, uptrend, sloping down, downtrend, sloping up, uptrend. So moving average tells you the trend direction purely from the slope. Next, on an uptrend, the moving average acts as a support level. So you can see it acts as a support. Can you see that? Support, 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 until it breaks the support, and then it becomes kind of like a resistance. Can you see the moving average becomes a resistance when it's on a downtrend, and on an uptrend again it becomes a support. Okay, so moving averages are really important. Now there are two kinds of moving averages. We've got simple moving averages, SMA, and exponential moving averages. So what's the difference? A simple moving average means you average the price over a predefined number of periods equally. So in other words, for the 50 moving average, simple, you take the last 50 periods, divide by 50 equally. That's a simple moving average. An exponential moving average, or EMA, is a weighted moving average that applies more weight to recent prices. So in other words, you take the last 50 periods of prices, you don't divide it equally. You place more percentage weight on the recent prices, and so it's called an exponential moving average. Again, you don't have to worry about the technicalities or the mathematics behind it. You just have to know when to use what, okay? Now, I tend to use the simple moving average for the 200 moving average, and for the shorter moving averages like the 6 and the 18 and the 50, I tend to use the exponential moving average, right, when it comes to trading my specific strategy, right? So I'll go into that in detail in the strategy portion, but for now, just have an idea about that, okay? So like I mentioned earlier, when you look at a moving average, you always look at the slope, right? The slope of the moving average indicates the direction of the trend. As you can see, it's sloping down, so that is a downtrend. Okay, it's sloping up, it's an uptrend. Sloping up, uptrend. Okay, so first is the slope. Next, again, moving averages act as supports on uptrends and resistance on downtrends. Again, check it out. On a downtrend, can you see that the moving average acts as a resistance, 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 right? Resistance, resistance, resistance. So those are really good times to sell short because the price goes up, hits the resistance, comes back down and continues the trend. And on an uptrend, you can see the price acts as a support. Can you see the support over there? Support, support, support. Now this is an ideal situation where we see at the support is a bullish pin. Can you see that? Now that's one of the techniques in my strategy, that the moment you see a bullish pin on a support, that's when you buy, right? And you ride the trend up as it bounces off the support. Now again, does this very nice pattern happen all the time? Of course not. If you look at the charts, you can see there are many times where the price doesn't find support at the moving average or doesn't find resistance, because many times price movements are random, right? They're random, right? But there are certain situations when the price pattern is very predictable. It goes into a certain pattern that's repeatable, and it's only during those situations that we trade the markets. So you can't find a trade every day, every hour, every minute. You don't have to. It's only when you see the price in a certain pattern, like so, do we enter the trade. And I can tell you that on an average month, I may only take 10 to 15 trades. But I only take the trades when they're showing me a very clear pattern. And that's why my win rate is really high and my profit rate is really high, because I don't enter the market randomly, right? Just to say, okay, I've got to take a trade today, and I go into a trade even though I don't see a very clear pattern. I gotta see a clear pattern, because most of the time prices are random, there's no pattern. But it's only special periods of time when you see a pattern appear, you go for it and you take it and you go for the kill. All right, so I'm going to teach you how to find these patterns that recur in a very predictable fashion. Okay. Now, another important point is to only buy and sell when the price is near the moving average. Near the moving average. Okay. So in other words, on an uptrend, do we buy or sell? Buy, right? On an uptrend, we always want to buy. Now, you always want to buy when it's near the moving average, or it just bounced off the moving average. Like this would be a good time to buy, right? Because it's near the moving average. Here's a good time to buy, near the moving average. Here's a good time to buy, near the moving average, right? Now, what happens when price gets too far from the moving average? Like in this case, you can see the price has gone way above the moving average. What happens is that the price is overbought, and it tends to snap back to the moving average. And that's why we call it an average, right? When the price goes too far from it, away from the average, like a pendulum goes too far from the center, snaps back. So it's really risky to buy when the price is too far above the moving average. It is overbought. Always wait for it to snap back, and buy near the moving average. Very important concept. Similarly, on a downtrend, we always want to sell, right? We want to sell short on a downtrend. So we want to sell when it's near the moving average. Like you could sell it somewhere here, right? You sell short, sell, it goes down, you make money. Sell, goes down, you make money, right? All right, near the moving average, sell, goes down, make money. Now you do not want to sell it here, for example. Why? Because the price has gone down too far from the moving average. It is oversold. And again, like a rubber band, when you pull it too far from the moving average, it snaps back. So it's really risky to buy when it's far from the moving average, snaps back. Far, snaps back. Far, snaps back. Always sell when it's near the moving average. Preferably when you just found resistance, that's when you sell. All right, so that's a very important concept to understand about moving averages. Okay, now, a very important concept to understand is that when the price is on a very strong uptrend, the moving averages are aligned in sequence from the smallest moving average to the biggest moving average. So I like to use moving averages like the 18 moving average, the 50, the 100, and the 200 moving averages, because these are the most commonly respected moving averages by traders. And can you see that the price is on a very clear uptrend, right? Why? It makes higher highs, as you can see, higher highs, and higher lows. And notice on a very clear uptrend, the 18 EMA is above the 50 EMA, and the 50 is above the 100, and the 100 is above the 200, right? It's in a very clear sequence, right? So that's the secret. I only buy when I see the moving averages in this sequence, right? From the smallest moving average, 18, 50, 100, and 200. Sometimes I may not even use the 100, right? I may just use 18, 50, and 200, it's fine. But that tells you a very clear uptrend. And notice again, on the uptrend, price goes up, breathes out, breathes in, breathes out, breathes in, breathes out. So we call these dips, dips, dips. So on a very shallow uptrend, notice the price again bounces off the moving average. So in this case, you can see that it is bouncing off the 80 moving average. Can you see? It's bouncing off the 80 moving average. Bouncing off, right? And again, remember we said this is a test, right? The body is above the moving average. The lower shadow cuts it. Can you see there's a test? Can you see there's a test? This is not a very good test because the body went below the moving average, but the next candle went above it. So that's also an acceptable test, right? When you see a bearish candle open above the moving average, close below, immediately next candle opens below, closes above, right? So remember, red candle open above, close below, then opens above, closes opens below, closes above, right? So testing the 80 moving average, right? Now sometimes it will test the 50 moving average, like so. So again, you can see a very clear uptrend where it's in sequence, 18 moving average. This is the 18, this red line, above the 50, blue line, 50 above the 100, 100 above the 200, in that sequence. So you want to see the sequence to know it's a clear uptrend, only then do you buy. And again, you can see, in this case, it bounces off the 50 moving average, right? It goes bounce, 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 right? Bounce, bounce, bounce. So there are times it bounces off the 18, there are times it bounces off the 50. It depends on the period which you're looking at. And again, this example here, you can see that again, this period over here, this was a clear uptrend. You can see the moving averages were in sequence. Here as well as in sequence, right? 18, 50, 100, 200. Well, this was kind of like the price was in jeopardy, right? It was kind of like going sideways. And you can see that it finds support at the 100 moving average. So price always tends to find support at one of the moving averages, okay? Depending on the volatility of the stock at that moment in time. Now, similarly, how do you tell it's a very clear downtrend? A very clear downtrend is when moving averages are in sequence in the opposite direction, where now the biggest moving average is on top and the smallest moving average is at the bottom. So again, you can see in this case, 18, the 18 moving average, the 50, the 100, and the 200. And the 18 is below the 50, 50 below the 100, 100 below the 200. Very clear downtrend sequence. So again, I only sell short when I see this sequence, right? 18, 50, 100 sometimes, and 200, okay? And again, notice on a downtrend, the price makes lower highs, and lower lows. There we go, lower lows, right? And again, notice it is finding resistance at one of the moving averages. In this case, it's finding resistance at the 50 moving average. You can see the resistance, resistance, resistance. So these are good times to sell, sell, and sell to catch the wave down, all right? All right, now the last thing I'm going to talk about is moving average crossovers, right? So a very common technique traders use to identify a new trend is when you see the moving average crossing each other, okay? Now, because I'm trading the short-term trends, I use the 6 and 18 exponential moving average crossover. And again, I'll teach you exactly how to use this in the strategy portion. So this is not the strategy yet, it's just an understanding of how this works, right? So basically, when the shorter term moving average, which is a 6, crosses above the longer term moving average, which is the 18, it's a short-term uptrend signal. There we go. That's the uptrend signal, right? So when a 6 crosses above the 18, that's an uptrend signal, right? And that's when we're going to start to get ready to buy. But we cannot just buy just because it crosses over. We also have to look at, that's right, candlestick patterns and support levels. And we'll learn that in the strategy portion. And when the 6 EMA crosses below the 18 EMA, like so, the 6 crossing below 18, it's a downtrend pattern. And that's when we go short. Again, we have to wait for the candlestick and resistance to confirm our short entry. All right, great. So that's all for moving averages. We're now going to the next section where we're going to learn about how to use the charting software known as MT4. So I'll see you then. Alright guys, so in this lesson I'll be talking about how to use the MT4 software or MT4 charting platform. Now, no matter what broker you choose to use, they will be able to go to that broker's website and download the MT4 platform as long as that particular broker offers MT4, which is a very commonly used software of most brokers. And it's a software which I use because I find it the easiest to execute trades and to analyze the charts, right? So once you download the software from whatever broker you want. So again, in lesson 8, I'll be talking more about how to choose a broker and the brokers that I use. And if you're interested, you can send an email to adam@akltg.com, which is my personal email, or support@piranhaprofits.com, and we'll link you up with the broker that we use because all my students, they use the same broker and they get a very special student rate, right? So for now, let me show you how to use this charting software, all right? So when you first download it, the first thing that you want to do is, now when you first, of course, download it, it doesn't look like this, right? It looks like all black. So you have to configure the charts, which I'll show you how to do in a short while. But the first thing to do is go to File over here, right? And go to New Chart. And when you click New Chart, again, you can select which are the pairs that you want. So you've got the major pairs, which is Euro USD, dollar yen, pound dollar, Aussie dollar, dollar CAD, dollar franc. Some of the minor pairs like Aussie CAD, Aussie franc, Aussie New Zealand, and so on and so forth. And I've talked about which pairs I trade in the past, right? So basically I trade the majors and some of the minors, all right? So I trade Aussie CAD, Aussie franc, Aussie New Zealand. I do not trade Singapore dollar or other currencies. I only trade the 8 major currencies which I've mentioned. So for example, if you go to Euro USD, click on it. That's right. You open a new chart that looks black. So what you got to do is, again, you have to configure the colors and put in the indicators, which we're going to do in a while. But notice every time you open a new chart, it will appear on a tab over here, right? So the tab comes up over here, and you can always right click and you can always close the tab. If you want, you can close it. You can open it again if you want to open a new one. For example, I want to open dollar yen. There we go, dollar yen, right? Now up here you can see the time frames which you want to trade. All right, so I trade on the 15-minute time frames. So click M15. So these are the 15-minute charts. Right now you can't really analyze it because it's really black. Okay, and then if I'm trading on the M15 charts, I will always confirm with the higher level time frame, which is the hourly candle. Right now, if I'm trading on the hourly time frame, which I do as well, if I'm trading on H4 time frame, I will click on H4, which is another higher level, to make sure that the trend is aligned. So whatever time frame you're trading on, you always want to look at a higher time frame to ensure that the trend is aligned as well. Initially, the chart looks black and green, looks terrible, so we're going to set it up to our favorite colors, right? So first thing is to right click on the chart and you get this box, okay? So scroll down, go to properties and go to common, select candlesticks. So there you go. So once you select that, you will see the candlesticks on display, all right? Go to colors And well, depends on your taste, but I kind of like the black on white background, right? So I like a white background. And for the bull candle, I'll put green. So bull means bullish candle is green. Bearish candle is red. Okay, so click OK, and your charts should look something like that. Now, this is the zoom in tool. You can click here to zoom in. So when you zoom in, you can see it looks more like what we talked about earlier on, right? With the red and green candles. You can also zoom out using this toolbar here. Zoom out. Okay. Or you can click and you can kind of like now, I would unclick this green arrow. When you click this green arrow, you will automatically scroll to the right of the chart. All right, so I tend to leave that unclicked. But if I want to go to the right of the chart, I'll click this red arrow. So the moment I click the red arrow, I go right to the end of the chart. So this is the current candle. You can see the market's open now, and you can see the prices are moving. Right, they're moving. It's changing. Right, and as the prices are moving among all the different pairs, Euro USD, dollar yen, pound dollar, Aussie dollar, pound yen, these are all the pairs. You can see the bid and ask. We talk bid and ask, right? So the ask always higher than the bid. And you can see that this candle is the current candle and is forming right now. It keeps changing. And every 15 minutes, it will close and start the new candle, right? So every candle is 15 minutes because we're looking at the 15-minute candles, right? If you look at the H1 hourly candles, these are the hourly candles. So you can see it's changing as well. And it will close after 1 hour, right? At the end of the hour, right? So now it's 3:49 on my clock. At 4 p.m., this will close and start the new candle. Okay? But for the 15-minute candle, it closes every 15 minutes. So now it's 3:49. At 4 p.m., it will close. Start a new candle. And the new candle will close at 4:15, right? Every 15 minutes, right? So that's how you look at the candles. Okay? Now, so what I do is I will create tabs for all the different currency pairs, right? So you've got Euro USD, Euro Aussie, New Zealand dollar, Aussie CAD, dollar yen, right? I create all the tabs. So all you got to do is go to File. Oh, sorry, before that. Now, once we have created this chart with the colors, right? You can do a right click and save. So go to template and save the template, right? So you could call it whatever you want, right? You can call it my template, right? Save it. So this saves your settings, right? So if you open a new chart, so we started with the Euro USD chart, right? So if you want to open another currency pair, you go to File, New Chart, and now you open the dollar yen pair, right? So you open all the different pairs. You've got the majors, you've got the minors, right? So there are many pairs you can open, right? You can look up to 10 or 12 pairs at the same time, no worries, right? So let's choose the dollar yen. So that brings you to a new chart that says dollar yen over there. And again, to apply the settings, you just right click, go to template, and load the template. So which one do you load? You load the one that you just created called my template, right? This one. There you go. Okay. If you want to get rid of the chart, just right click, close, and it's gone. All right. Cool. So one of the first things to do is to put in the moving averages. Okay, put in the moving averages. So how do you do that? Well, you go to Insert, indicators, trend, moving average. Okay, so put moving average. And the first moving average you can put is the 200 moving average. So put 200, red, and you can put the line to be thicker, right? This one, thick line, okay. So you got a 200 moving average. There, that's your 200 moving average. Okay. Next, we could put in the 50 moving average. Insert indicator, trend, moving average. Now we're going to change it to 50. And for 50, I'm going to use the exponential moving average. Blue. And again, I'm going to choose a thick line. Okay, there we are. That's the 50 moving average. Okay. And for the purpose of my strategy, we're also going to put in the 6 and the 18 moving average. So let's just do it right now. We're going to go to insert, indicator, trend, moving average again. And this time we put 18. Now for the 18 moving average, we're going to keep it blue, but we're going to make it a thin line. Right, so we can differentiate the 50 from the 18. Right, so the 18 is the thin line, the 50 is the blue line. And insert again indicator, trend, moving average. 6 exponential, red, and thin line. Okay, so there you go. So what we have here, and you can see this is a period of time when it was on a clear downtrend, right? So the 6 below the 18, below the 50, below the 200, clear downtrend, right? See clear downtrend? 6 below the 18, 18 below the 50, 50 below the 200. Now notice I didn't put in the 100 moving average. I don't usually use the 100. For my strategy, it's just a 6, 18, 50, and 200, right? And so this is for the 50-minute candles. Right now you can see it's a clear uptrend, right? 18, 50, 100, 200 in the sequence, it's a clear uptrend, okay? So once we put in the moving averages, we can right-click, template, save the template. So now we're going to save it, and we're just going to call it, well, you can call it impulse pullback, because that's the name of the strategy, right? So whenever we want to use the strategy, we're going to use the impulse pullback settings that will put the moving averages in place. All right, so there we are. We have set up the moving averages. We've set up the charts. Now another thing that you could look at would be the line drawing. Okay, so for example, let me just zoom out. Okay, now if you like to draw lines, for example, like draw some support or resistance levels, you see certain support. Now I don't really use support and resistance that much in my Forex strategy. I do at times, but not always. But if you want to, you could. So you could click on this line. And what this does is that you click on it and you can move it and you can put a line there to indicate a resistance, for example, if you want to. Okay, so this line is to draw horizontal lines. And if you want to draw kind of like diagonal lines or trending lines, you can use this line, click on that, and you could do something like that. All right, so these are to draw lines. If you want to change it, you could double click or right click, delete it. So you could delete it anytime, right? Delete. Double click, right click, delete. Right? Now if you're using a Mac and there's no right click button, just use 2 fingers, put it on your trackpad, and it creates the box that you want. All right? All right. So that's pretty much all you need to know about, creating the charts, candlesticks, moving averages. That's it. There's nothing much more you need to know at this point of time. Now, on the MT4 platform, you can also trade with it, you can buy and sell, and for that, you go to View, Terminal. So click on Terminal over here, and it brings out this terminal, right? Where it tells you how much money you have, your equity, which is your net liquidation, how much cash you put in. So it's 5,200, for example, it's there. And if you want to place an order, you click here, New Order. Okay, and again, under the lesson on placing orders, you would also see this, right? So you can put how many lots you want to trade, right? So for example, if you put 1, that means 1 lot, or that means 100,000 of the base currency, right? If you put 0.5, that's 50,000 of the base currency, right? So every 1 lot is 100,000. Remember that? Okay, and you can place an order, which is a market execution, which means you buy and sell at the market price, which is at a bid and ask. This is a bid and ask, you can see the spread, right? There's a spread. Or you can put a pending order where you can buy limit, buy stop, sell limit, or sell stop. So all this is covered in the lesson on placing orders, right? And you can place the order, you can place your stop loss over here and your take profit over there, right? So pretty simple to use once you get a hang of it, right? And if you got any questions, you can send me an email. So if not, that concludes this part of the lesson on using the MT4 charting platform. All right, so now we've covered the main concepts of technical analysis. Here's a very quick afterword and some important thoughts before we start to use technical analysis in our strategy. First of all, it's putting things in the right perspective. Now, many people use technical analysis, right, moving averages, indicators to predict where the market's going to go. So they say, hey, the price crossed over, the EMA crossed, the price is going to go up, it hit the support, it's going to go up, it broke the support, it's going to go down, and when it doesn't, they say it doesn't work, or they get disappointed, right? Now, one thing to understand is that indicators, moving averages, candlestick patterns do not cause prices to move. Remember that, right? It is crowd psychology, emotions in the market that drives price movements. So the market is not obliged to respond to indicators. So just because the 6 EMA cross above the 18 EMA, it doesn't mean the price must go up, right? The price can still go down, right? So understand that all indicators by nature are lagging indicators. They are always based on historical data, and there's no such thing as future data. And in other words, foresight is always a matter of probabilities and never certainties. We never use technical analysis to predict with certainty because there is no certainty, right? We use it to anticipate the probability of price movements. In other words, we can't get it right all the time, not 100%, but as long as we keep applying the technical rules where we identify and we exploit repeatable price patterns over a large sample of trades, we're going to be right more than we're wrong. And as long as we win more than we lose based on our position sizing, we will always make money as a trader. And that's the secret. That's the key to being consistently profitable. Okay, so our job again is to identify high probability trades and not to predict where the market is going to go by using a combination of indicators, right? Our candlestick patterns, our moving averages. And as long as we have a high success rate, you ensure that our wins more than cover our losses. At the same time, understand that any trade you go into could be a loss. You never know which one will be a losing trade, which one's going to be a winning trade. There's no sure win, okay? So we must always have a reasonable stop loss placed away from the immediate noise. And my suggestion is at least 8 pips away from our entry price. And we always limit our position size so we risk a small percentage of our capital so our losses are kept small. And we must have the mindset to think in terms of probabilities that, hey, we could have 4 losing trades in a row even though we follow the rules of a good system. We can also have 4 winning trades in a row when we follow a good system. So in a short run, outcomes are random and we should avoid the lure of instant gratification. It says every trade must work, every trade must make money. And when it doesn't, you get disappointed. When it doesn't, you start to change your strategy. And in the long run, you go around in circles and you never become consistent. So it's not about making every trade work, it's about ensuring that you keep following the system, precisely executing each trade exactly, and that will ensure that you make money over a number of trades. So with that, that concludes lesson 3, mastering technical analysis. And once you understand this, you can then go into understanding the specific strategies to use to trade consistently. I'll see you in the next lesson.